All right, I wanted to quickly go over, the turning point. All right. So above is the YM. This is all the YM, but different charts. So you have the daily, and you have a bunch of other stuff. So here's the thing. This right here is a breakout. So one type of trade is the test of the breakout. So every white coffeean knows this. Your breakout, look at what happens on the test of the breakout. So market goes up, comes right back down to test the breakout. As it comes to test the breakout, that's when you want to look for a trade. That's one type. And before I go on a tangent, actually I will go on a little bit of a tangent and explain something. Give me 1 minute. Alright, so this is important because I talked about springboards before and what they are, but I want to just refresh on springboards. Not springs, but springboards. Alright, springs are more of like a test of support that lacks follow through. Anyway, alright, so far, what is a springboard? As you know, you have this classic diagram of accumulation, pardon my whatever, markup, distribution, right, and then you have markdown. This is the basic cycle, and it doesn't necessarily have to do anything with trend. It doesn't have to be only trend. This can also be a wave, meaning this. There is accumulation here. There's markup here. There's distribution at the top. There's markdown. Then there's accumulation. Then there's markup. Then there's distribution. Then there's whatever, distribution in the form of profit taking. These are the minor ones. And then markdown, meaning the pullback, then reaccumulation, etc., etc. And then of course this thing happens on a massive level, and that's when you have, like, that this for an entire trend that goes boom boom, right? So this cycle, it's nothing. This is basically buying low, selling high. That's all it is. But it's in the form of the classic terms. It's all it is, buying low, selling high. With just terms that describe that. Okay, now why I'm doing this is to explain something. What you're trying to do as a white coffee trader is get markup and markdown. I hope that made that clear. Can't get any clearer than that. All you're doing is trying to get markup and markdown. Alright, so what happens to the market before it's in market down is a state of, you could call it springboard. It's on the springboard. Springboard to mark up or mark down. So this is what I'm trying to get at. Wyckoff said trade this. That's what he said. Alright, so you want to see markets that are on the springboard. And when they're on the springboard, they are getting ready to mark up or mark down. Bullish springboard, you're ready to mark up. Bearish springboard, mark down. So what do we mean when we say springboard? Alright. Springboard come in a couple of flavors. The criteria for what is a springboard is when a market is ready to mark up. So that means there must be some type of springboard, but what is that? I found like there are 3 types for the market is going to mark up. Yes, there's some others as well, and I'll just touch base on that, but basically this is what it is. Ding, 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 ding. Alright, so this is your climax. and that is your secondary test. All right, your climax and your secondary test. So why is it climax? Market keeps on going down, 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 and then it overshoots into an oversold position, and it's overextended. When the market overextends and there is panic, which is described by high volume, and a move straight down, it climaxes. After that, you want to take a look at a secondary test. If it's on low volume and unable to really break the low, sometimes it does break the low and it's a shortening of the thrust. That happens. But in general, it is unable to continue its move down. This is the first type of springboard. And this is real Wyckoff, not that shit you watch online. Alright, so this is climax secondary test, and this is what he started talking about in section 7M right at the first page. This is what you're going to find when you use that New York Times average of 20 or 30 stocks. So this is the first behavior. Like he really hones in on the climax and then talks about it being a springboard. That secondary low volume test of a climax is the springboard. I can't say it any more clearer than that. This is what we'll call springboard 1. Okay, now step 2 is identifying what is the second type of springboard. We'll call that SP springboard 2. This happens when you ding, 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 climax, had that first type, market moves up, ding, and it's just low volume here, and confirms the trend. Here on low volume, when this low volume or low distance, meaning a small amount, a move that's very small, here, this is your second type of springboard. If you learn from Weiss or some other dudes, you know that he calls this the feather's weight. I forgot what Wyckoff said is that at the end of every small move, I forgot what he exactly said, but the point is there was a point that he said if you find this point at the end of every swing, you have a lot to gain and little to lose, something like that, or some other stuff. But anyway, I don't want to get into all of that, but this is it. This is your second springboard. Alright, and this one's real nice because it usually has a markup bar right after it, meaning a big bar, which helps confirm this as a springboard. That'll be a different point I'll discuss later. So this will be your change of behavior, also known as a sign of strength, and in a schematic known as your automatic rally. This will be your climax, that you can call your secondary test, right, which is your first springboard. Then here you have your change of behavior, and then you have low volume here. This is again this is your second springboard. Now here's the third springboard opportunity. As the market, as the market comes here, it starts doing this, or it breaks out. Typically, it's one or the other. As the market approaches resistance, it starts moving sideways and absorbing this. So we'll just call that absorption. Absorption is another type of springboard. Let me make it very clear. Absorption is another type of springboard. Yeah. Here, absorption. This is your springboard 3. And you see how it's sequenced. Springboard 1 has to do with the secondary test right here. So I'll just put that SP1 puts 2T. Okay, secondary test. So you understand it's climax and then the secondary test takes place. A successful test of the climax is your first springboard. All right. Your second springboard comes after your sign of strength, and sometimes people call this your LPS, and on the bear side I'll call it your LPSY, whatever. That is your second type of springboard. It must have a change of behavior in the background. The first type must have a climax in the background. The second type must have a change of behavior in the background. And the third type is absorbing at resistance and ready to fly. Why are all of these springboards? I have no idea. Alright? Why it's called that. But the criteria of the springboard that I'm explaining here is the market is going to go into markup. After accumulation, it will go into markup. That springboard, as I'm explaining it, is right before the markup. So the markup, the first earliest indication of a trend change, of an uptrend starting, is after the secondary test. The second is after the COB and then pullback and a low volume pullback with LPS, whatever. That is also setting up for markup. And then finally, the third one is absorbing resistance and going into markup. Okay, so when one trend ends and the potential for another trend is there, which is what happens on the first springboard, the market is the trend is changing, so it's going to go into markup. Okay, and then these are just within the range and ready to go for markup. I don't want to keep it too complicated. Just remember the three types of springboard, and I'm harping on it over and over again so you get it. One is the secondary test after a climax. The second is the LPS, which happens after your sign of strength, and the third is absorption against resistance if in an uptrend or against support in a downtrend. That absorbing supply is doing so it can fly. It can go into markup. So these are the three types of springboards. Now, one may also say that, yeah, well, there's other ways to enter a springboard. Yes, you are right. There are other ways that markets mark up. I'm not labeling everything here, and it's not a good strategy to use everything because it's just gonna mess up. The other way to do it is what is it? When you have a spring, right? This many times can yield markup. Not all the time, but many times can yield markup. When you have a spring, it can yield markup, and you have to be very careful with this. You have to know what you're doing, because this is a special type of spring. It's not the spring against the trading range. It's a spring against a minor trading range, which is like in a pullback position. And you have to be careful with this, and you have to know what you're doing. All right. Then there's the other type, which is in the form of like a lot of dullness. We know that when that happens, markets have a tendency to fly also. So using that criteria, you could say, well, there's so much dullness, also known as effort reward. I mean, the difference is dullness just has a lot of time, and over that time, you have a lot of volume accumulating, and that volume accumulating on a wave chart is what people call effort reward. Wyckoff used the term dullness because it could be low volume. Most of the time it's high volume because you have so many bars there. But the fact that it's so dull means supply is gone and the market's going to fly. However, these two, people just know them as behaviors, and they're not classically referred to as springboards. The classic springboard is this. this climax and secondary test. No one can argue that, because Wyckoff himself talked about it. I mean, that's how he opened it up in his first study. The second one, about this one here, this one was that low volume pullback after the change of behavior, and the market is on springboard. He did talk about that, but I mean, this is what David Weiss mentioned a lot. All right, and the third one, absorption, to me it's obvious that that's a springboard. Why? Because what happens after absorption? You fly, right? So I have seen other other behaviors when it goes like this and it goes into a very tight range, and you can say that, oh, market's forming a springboard based on the way it looks, like a triangle, and saying, oh, that's a springboard. Why? Because that's how springboard looks. It's like that. It's narrowing and then you spring, right? So, but why I'm mentioning the ones above is that the first type is based on a low volume and price and volume being very low amount of price and volume, and that low amount of price and volume is an indication that supply has stopped. The second one here is also based on a small move, and it is an indication that supply has stopped. Also note that this second one, Wyckoff really did talk about it. It's not just David. Wyckoff talked about it in his if you want to see a very clear example, in Division 2 of the course. If you take a look at Division 2, it talks about where to take the trade on a tape reading chart, on a intraday wave chart. So what he does this. There's a study, and basically what happens is he mentions that, oh, the time and the volume of the down waves increase significantly right here, right there on that pullback. The time and not the time and the volume, the price and the time. I want to make it very clear because he used price and time on that first study. Price and time increased, and then on this up wave, the price and time was very small, very, very small. It was smaller than at least all the waves. So the price and time on this wave, on this pullback, was greater than all of the other up waves. The price and time of this up wave here was so small that it was greater than this one, this one, this one, and this one. It was preceded by the biggest down wave in this one, this one, this one, and this one. So there's that big down wave down, followed by a very small, shallow up wave in terms of price and time being very small amount of ticks. And I think it was only 10-minute wave that he decided to take the short as soon as this turned. He took the short. Okay, so what does that mean? It means that the market had exhausted on this prior up wave here in terms of climax. He didn't use the term climax, he just used the term exhausted. But we know that that's interchangeable. Market's exhausting. One way to do it is through a climax. Then he indicated that this wave down was the biggest selling wave in multiple waves, and we know that to be later on labeled as a change of behavior. And then this pullback here was very small. We know that to either be called FW, feathers weight, or low volume pullback, or what was the other one, LPS, LPSY, whatever you want to call it. I don't really care. But the idea here is exhaustion confirmed. Exhaustion in terms of a climax confirmed by the small wave. The small wave confirms that the prior big wave exhausted the buyers, and between them you had selling pressure, which was biggest amount of selling pressure in multiple down waves. All right, I think I did it. All right, so that's the same thing that I'm describing here in the Springboard. All right, so in Springboard 2 over there with the COB and the low volume pullback afterwards, which David used to like to look for. Anyway, so where am I now? And the third one I've already explained to you is the absorption. I'm pretty sure that Wyckoff mentioned this, but I don't recall it clearly, but I know from a conceptual point of view that this is obviously a point where you're going to absorb resistance, and if you do that, you've absorbed the range, whatever's left in the range, and then you're going to go into markup, right? So what is the whole point of this? The whole point of this is you have to identify what is it you're going to trade, and those behaviors you're going to trade need to be observed and what you're looking for, otherwise you'll be lost. So if you're going to trade springboards, there you go. I've identified the 3 types. The other 2 are also like springs and test of springs. That's very common in Wyckoff, but you have to be really careful with that and know the stop management, because if you just say took out a prior low, you know, it can spring a spring. So you have to be really careful with this, and whether it's high volume and low volume, it could be any volume. It could be high volume because it's a minor climax, or it took out the lows or whatever, and then it could reverse. It could be low volume because there's no supply there. So the volume has nothing to do with the effectiveness of the spring, in my opinion. I know some people will be saying it has to be low volume, but I've seen plenty of high volume springs. Shakeouts. These are minor shakeouts. The other is effort reward. Again, you know what to look for. So, but I'm going to just focus on these 3 that I'm explaining. One being the secondary test after the climax, which is legit. And second is this. No one can argue these 2. And then the third one, I believe, is also a springboard because it's about to go into markup. And the 4th and 5th, these are actually just setups, but you will see them before markup many times. A spring, or spring with a test of spring, and the other one being effort reward, meaning a heavy wave down, very dull. Okay, but my recommendation is to focus on these top 3 or the top 2. These 2 are solid. All right. The other thing I want to mention is usually on this climax and secondary test, on the lower time frame, there will be heavy buying. It's not, you don't just take a look at it on one time frame. You want to go to the lower time frame and see what is happening after that climax, what is happening after that secondary test. This will help confirm that the buyers are very strong, and what you will many times see is a big automatic rally. And if you look at the lower time frame, that automatic rally has tremendous amount of volume, like especially in the form of a wave chart. Anyway, I'm done with this. Yeah, I'm gonna go back to the charts, and what I want to do is I want to explain a type of turning point that occurred here. So the market is going down, and you see here it broke out and decided to test of a breakout. Really that simple. You have a breakout, you have a test of a breakout. Okay, let's see what's going on the test of the breakout. So the first thing to see is that there's a trend. It's trending down, right? Now you want to see what is indicating weakness in trend. Weakness in trend can come in a number of forms. One form is its ability to thrust, and what I see is that there's a shortening of the thrust, meaning these thrusts from low to low to low are shortening. They're only 1 brick. Okay, you see this? How much is the thrust? 1 brick. What about the following one? It's actually even less. From this low to this low, it's like half a brick. So what does that mean? It means from low to low to low, the thrust has shortened. Very clear. So it means that the downtrend is weakening. Why? Because breakdown sellers are not selling. The sellers are just not selling. You know, when you take out that support level and it's going below, it's not really doing much. So that's one observation. Those breakdown sellers are not selling the breakdown. Second is the pullbacks that are resulting after those breakdowns have increased. You see these are 1 brick and 2 brick. This is 3 bricks. This breakdown yielded 3 bricks. This breakdown with not only shortening of the thrust, but also yielded 4 bricks. So the breakdowns are being bought. Breakdowns are being bought. You see? So what is the weakness here of the downtrend? On the selling side, there's a shortening of the thrust, meaning the breakdowns are not making much progress. And on the pullbacks, they're getting bigger. They're getting bigger, which means that the breakdown sellers are not there or unable to push the market down. And instead, the buyers are finding very nice levels to go long, and they are buying off of them, buying the breakdowns, right? So that's one thing. The second thing is the amount of volume that is also diminishing. So what are two indicators for a weakness of trend? One is the shortening of the thrust, indicating that the breakdowns are not making progress. The other is that every breakdown is getting lower and lower in volume. You went from 202 to 89, 72, 41, 38. So what's that saying? As you're making lows, there's less and less selling pressure. Market is not going to keep on going if there's less and less selling pressure, or at least it would need more selling pressure to come in order to break. Or bulls may come in with their buying pressure. In this case, the bulls did come in with some buying pressure, and that buying pressure was yielded 4 bricks. It was more visual in terms of, and then later on they came back here, and that's where they really pushed it. So here it's indicated from a perspective of price more than indicated from the perspective of volume. Why? Because 4 bricks is bigger than 3, 1, 3, 2, 1, 1. Bigger than 1, 2, 3, 4, 5, 6 prior waves. So buyers are coming in. As you can call that your change of behavior if you like. Call this, you could also call this, because this one is supported more by volume. It's more volume than 1, 2, 3, 4, 5, about 1, 2, 3, only 4. But it is volume and it has distance. So after that, this is where it gets interesting, and this is where it gets confusing too. A lot of times when the volume dries up, there's one more final drive down, and this can happen after your change of behavior. This is not what you're not going to find this talked about a lot, but many times this is what happens. They will have one more drive down, and that is after the change of behavior, or actually after that automatic rally. You know, you see the classical chart saying climax, automatic rally, secondary test, but they never explain to you that you can have a sign of strength, and then after that you could have heavy volume selling, almost climactic selling after that sign of strength. This is a very real situation. It happens all the time. There's no schematic for it, and this is just on a minor scale. You see this 72? It's bigger than 1, 2, almost 3, 4. Nah, not really. But it's bigger than prior 2 waves and a number of up waves. Actually, it's bigger than all the up waves. 1, 2, 3, 4, 5, 6 up waves. So this final drive down, it actually happens within that range, and it is something you need to expect, because if you don't, you think that selling has started again. But selling has not started again. It's just like a final drive down, and it will exhaust the sellers. But if you don't know that and you're just looking at volume, you think selling has started again. but it's really ending the selling. So that's what happened here, where you had this drive, this heavy volume go down like that. And let's see how much volume it had. Let me see this. 7,000. Well, 7,000. Anyway, 7,200. So that was exhaustion within the range, after the COV, and that's it. And after that, you have another more important rally or COB or whatever. And here is where the sellers give up. Meaning, you know why they give up? Because they exhausted themselves right here. That's why. They exhausted themselves right here and gave up right here. From 4 bar to 1 bar, and the volume itself is also very little. It's 1 volume lower than all the other bricks. Look at that. All the other bricks. This is a no supply. How else do you want me to say it? Zilch. Supply is out of here. Clear indication that there's, right there. So, because you know why? Because they exhausted themselves on this. This is in the range on that drive down, right? Some change of behavior, drive down, they're totally exhausted, buyers picked up, no selling, initiate markup. All right, folks, thank you. Bye.